A candy shop made Warren Buffett more money than most tech stocks ever will. He paid $25 million for it in 1972. Since then, that little box of chocolates has handed him over $2 billion in profit. No app. No disruption. Just fudge and peanut brittle. So why does the most boring business he ever bought keep beating the exciting ones? Here's the trap. We chase the loud, thrilling stocks and ignore the quiet machines printing cash in plain sight. Today I'll show you why boring wins, using 3 real businesses that turn dull into a fortune. Buffett calls Candies the dream business, and the numbers are absurd. He and Munger paid $25 million in 1972. The business earned about $4 million that year. By the 2010s, it had returned more than $2 billion in pre-tax profit, on almost no new investment. Think about that. They put money in once, and it just kept paying, decade after decade. That's the boring magic. See's didn't need factories or research labs. It needed one thing, the ability to raise prices a little every year, because people love the brand. And here's the pull forward. Se's isn't the exception. It's the pattern. Let me show you why boring beats brilliant. Exciting companies come with a hidden fee. I call it the excitement tax. When a story is thrilling, everyone piles in and the price gets bid up far beyond what the business is worth. You pay for the hype, not the profit. Boring companies get the opposite treatment. Nobody brags at dinner about owning a company that sells industrial fasteners or paint. So the price stays reasonable. And reasonable prices are where great returns are born. Look at Sherwin-Williams. It sells paint. That's it. Buckets of paint since 1866. And over the last few decades it's been one of the greatest wealth compounders on the entire stock market, quietly, while nobody was watching. So let me ask you something. Think about the last stock you bought. Were you buying a business, or buying a story? Tell me in the comments, story, or business. But here's what nobody tells you about the boring ones. The counterintuitive truth? Boring is the safest place your money can live. Exciting industries attract competition, disruption, and hype cycles that vaporize fortunes. Boring industries barely change for 50 years, and that predictability is a superpower. Here's the stat that stops people cold. Domino's Pizza went public in 2004. A pizza company. And from that IPO through 2017, Domino's stock outperformed Google, Apple, and Amazon. Pizza beat the tech titans. How? Not by being exciting. By running a dull, disciplined business, better delivery, better ordering, relentless consistency, and reinvesting profit for years while everyone stared at flashier names. Nobody puts a pizza box on a magazine cover. And that's exactly why it was cheap enough to make owners rich. So how do you find these boring winners before the crowd? Look for 4 boring traits. 1. A product people buy over and over, out of habit. 2. Pricing power, the ability to nudge prices up without losing customers. 3. Low need for new capital, so profit flows to owners instead of back into the machine. And 4. An industry so unglamorous that Wall Street forgets it exists. Se's had all 4. So did the paint company. So did the pizza company. This is educational, not financial advice. Always do your own research. But the framework is timeless. Look past the story. Count the cash. Remember what I said at the start, a candy shop out-earned the tech dreams. That's the whole lesson. The market pays a premium for excitement and hands a discount to the boring. And discounts are where fortunes are quietly built. The flashiest stock in the room is rarely the richest. The best business you'll ever own might be the one you'd be embarrassed to mention at a party. So did this flip your thinking? Is boring actually better? Yes or no in the comments. Tomorrow I'm breaking down the one number that reveals whether a company can raise prices without losing a single customer, and it's the number that separates a good business from a great one.